What if I told you that financial charts aren't just a bunch of random lines and colors on a screen? What if they were actually a secret language? A language that tells an incredible story of human emotion, a constant, epic battle between fear and greed. Well, today we're going to start learning that language. Our story actually begins way back in 18th century Japan, with a legendary rice trader named Munehisa Homa. Now, this guy became one of the most successful traders in history, not because he could predict the future, but because he had a breakthrough realization. Price movements are driven by human emotion, and to track that emotion, he developed a game-changing tool, the candlestick chart.
And that quote right there, that is the core idea for us today. The goal is that by the end of this explainer, you'll be able to look at a chart and start reading the stories that the market is telling you.
So here's our game plan. First, we'll talk about why these charts tell a story of human psychology. Then, we're going to learn the alphabet by decoding just a single candle. After that, we'll form some simple words and even a full sentence with some classic patterns. Learn how to trade one of them, and finally, tie it all together.
You see, Homa's great insight was that the price of rice wasn't just about supply and demand. Nope, it was super heavily influenced by the emotions of the traders themselves. It's this constant tug-of-war between greed, which, pushes prices up, and fear, which yanks them back down. And all of that drama is visually recorded right there in these charts. Okay, let's dive right in. To read the story, you got to learn the alphabet first. And the most basic letter in this entire language is a single candlestick. Think of each one as a snapshot, a single frame in a movie that shows the battle between buyers and sellers over a specific period of time. So, a candle has two main parts. That thick part in the middle, that's called the real body. It tells you where the price opened and where it closed for that session. And those thin lines sticking out the top and bottom, those are called shadows or wicks, and they show you the absolute highest and lowest prices that were hit. A long body means it was a decisive victory for one side, while a tiny little body shows a much weaker, more indecisive push.
And the color? Well, that tells you who won the battle. If the candle is green or white, it means the price closed higher than it opened. We call that a bullish candle. The buyers or the bulls won that round. If it's red or black, the price closed lower than it opened. And that's a bearish candle. The sellers or the bears were in control. See? Simple, right?
But the shadows. The shadows tell an even deeper story. A long upper shadow means buyers tried to push the price way up, but sellers fought back hard and shoved it back down before the session ended. And a long lower shadow? That tells the opposite story. Sellers tried to tank the price, but buyers stormed in forcefully and said, "No way." Think of these shadows as clues. They signal price rejection and can be hints of a potential turning point.
Okay, alphabet's down. Now the fun begins. Let's see how these letters combine to form our first words. These are simple patterns, sometimes just one or two candles, but they can tell a surprisingly big story about a shift in the market's momentum. Our first word is the hammer. Just look at it. It's got a small body up top and a really long lower shadow. The story it tells is so powerful. During this session, sellers took total control. They pushed the price way down. But then a huge wave of buyers came rushing in with incredible force, rejecting those low prices and driving the price all the way back up to close near where it opened. What a comeback.
And look at how this plays out on a real chart. You see a clear downtrend, things are looking bad, and then bam, the hammer pattern forms. That story of buyer rejection wasn't just a one-off event. It signaled that the sellers were exhausted, and it was immediately followed by this powerful reversal and a strong move higher.
Next up, we have the bullish engulfing pattern. This is a two-candle story. First, you've got a small bearish candle, showing the sellers have a bit of control. But then the very next candle is this huge bullish one that completely engulfs or swallows the body of the previous candle. On a chart, this pattern is just pure drama. It means there's been a complete and decisive takeover. Sellers were in the driver's seat, maybe for a little while, but then the buyers stepped in with overwhelming force, basically erasing the previous day's losses and shouting that a new uptrend could be starting right now.
All right, so now that we've got some words down, we can start forming a full sentence in the market's language. And a perfect example of a longer story told by these candles is the famous cup and handle pattern.
Now, unlike the hammer or the engulfing patterns which signal reversals, the cup and handle is what we call a continuation pattern. It usually shows up during an existing uptrend, and it's basically the market telling you that after a little pause, a little consolidation, the trend is very likely to resume its climb upwards.
And the name is pretty literal because the pattern really does look like a teacup. The cup part is a nice, rounded, U-shaped bottom. That's a really crucial detail. That U-shape shows a slow, stable bottoming process where buyers are gradually building a solid foundation of support. A sharp V-shaped bottom, on the other hand, is usually way more volatile and less reliable. And after the cup, you get the handle, which is just a short, slight drift downwards or sideways.
But, just recognizing the pattern is only half the battle. How do traders actually translate this story into a concrete plan of action? It's not just about seeing the pretty teacup shape. It's about knowing how and when to act on it.
A really common approach for this involves 4 clear steps. First, obviously, you identify the pattern. Second, you enter the trade when the price breaks out, which means it moves decisively above the top of the handle. Third, you set a profit target. And fourth, and this is absolutely critical, you place a stop loss to manage your risk.
Now here's a really cool and common way to set that profit target using the pattern itself. What you do is you measure the depth of the cup from its lowest point all the way to the rim. Then you just take that same distance and project it upward from the point where the price broke out of the handle. It gives you a really logical price level to aim for.
And to protect yourself if the pattern fails, which can happen, a stop-loss order is usually placed just below the lowest point of the handle. If the price drops down to that level, the trade is automatically closed, which limits your potential losses. This is fundamental, non-negotiable risk management.
So let's bring all this home. If you remember just one thing from our time together today, it should be the power of this learning a language metaphor. We started with the absolute basics, the alphabet, a single candle showing that raw conflict between buyers and sellers. Then we moved on to words, simple patterns like the hammer and the engulfing that signal a big change in power. Then we actually read a full sentence, the cup and handle, a longer story of consolidation and continuation. It all comes back to one central idea. Charts are a visual record of human psychology in action. By learning to read candlesticks, you're not getting a crystal ball to predict the future. No, you're learning to listen to the story the market is telling you right now in real time. The patterns are out there, they're happening every single day, so the only question left is, are you ready to stop just looking at charts and start listening to them?